pause for a moment. Before we talk about crashes, recessions, or markets, I want you to forget everything you think you know about 2008. Forget the images of collapsing banks, forget the dramatic stock market freefall, forget the moment when everyone suddenly realized something was wrong. Because what's coming next, if it comes, will not announce itself that way. It won't feel sudden, it won't feel obvious. And that's precisely what makes it more dangerous. Here's the uncomfortable truth. The most damaging economic crises in history are not the ones people see coming. They are the ones that feel normal, right up until they aren't. And right now, the global economy is entering a phase that looks nothing like 2008, but follows a pattern that history has seen many times before. If that sounds dramatic, stay with me. Because this is not about panic. It's about understanding systems. And once you see the pattern, you can't unsee it. In 2008, the crisis was loud. Banks failed publicly, markets collapsed visibly. Governments rushed in with emergency measures that were obvious to everyone. The damage was severe, but the signal was clear. This time, the signal is different. Today, markets are still functioning. Banks are still open. Employment numbers still look fine on the surface. And yet, beneath that surface, something has shifted. Not broken, shifted. And that distinction matters more than most people realize. Let's start with the central idea of this documentary. The danger ahead is not a sudden collapse. It's a slow distortion. A system that continues operating, but in a way that quietly transfers risk, pressure, and instability downward. In other words, the system doesn't fail all at once. It absorbs stress until the stress shows up somewhere else, and history shows us exactly where that stress usually goes. To understand why this moment is different from 2008, we need to understand what 2008 actually was. The 2008 crisis was a balance sheet crisis. Too much leverage, too much risk concentrated in one place, too many institutions exposed to the same failure. When housing collapsed, the damage moved directly through the financial system. That made the threat visible. Banks failed, credit froze, markets panicked. The response was massive but straightforward. Liquidity was injected, rates were cut, assets were backstopped. The system survived, but at a cost. And this is the part most people forget. 2008 didn't remove risk from the system. It relocated it. After 2008, something changed quietly but permanently. Central banks became the primary shock absorbers of the global economy. Interest rates were held near zero for years. Trillions of dollars were created to stabilize markets. Asset prices were intentionally supported. This wasn't accidental. It was policy, and for a long time it worked. Markets recovered, growth returned, confidence stabilized. But every solution creates a new constraint. And by solving the last crisis, the system planted the seeds of the next one. Here's the critical difference between then and now. In 2008, central banks had room to act. Interest rates could be cut aggressively. Debt levels were lower. Inflation was not a constraint. Today, that flexibility is gone. Rates are already elevated relative to the last decade. Debt, public and private, is historically high. Inflation has re-entered the system in a way most policymakers didn't expect. That changes everything, because now the tools that saved the system last time carry their own risks. And that means the next crisis won't look like a crash. It will look like friction. Friction shows up slowly. It looks like housing becoming permanently unaffordable. It looks like wages that rise, but never quite keep up. It looks like jobs that exist, but feel less stable than before. It looks like markets that don't collapse, but don't really grow either. This is not a sudden failure. This is stagnation under pressure. And historically, this is how financial stress migrates from institutions to individuals. Here's where the historical pattern matters. If you study major economic disruptions across centuries, not just decades, you see a recurring sequence. First, financial excess builds quietly. Then a visible crisis occurs. Then authorities stabilize the system. And finally, the cost of that stabilization shows up in everyday life. The crash grabs headlines. The aftermath reshapes societies. The danger isn't the moment of collapse. The danger is the decade that follows. This happened after the Great Depression. It happened after World War II. It happened after the inflationary crises of the 1970s. And in a different form, it happened after 2008. But this time, the system is more interconnected, more leveraged, and more dependent on confidence than ever before, which means the margin for error is smaller, and the consequences of slow failure are larger. Now, let's address the question that's probably forming in your mind. If this is so dangerous, why doesn't it feel urgent? Because systems rarely fail at the moment they are most unstable. They fail when confidence shifts. And confidence doesn't collapse overnight anymore. It erodes. Look at what's happening right now. Banks are more regulated than before. Capital requirements are higher. Stress tests exist. On paper, the system looks safer. But safety on paper is not the same as resilience in reality, because modern risk doesn't live where it used to. It lives in duration. It lives in interconnected debt. It lives in assumptions about stability. And assumptions are fragile. This is where the comparison to 2008 breaks down completely. In 2008, the system was overleveraged and opaque. Today, it is overextended and rigid. That rigidity matters, because when systems lose flexibility, they don't snap, they grind. And grinding systems don't make headlines, they make life harder. Here's the part nobody talks about. A slow-moving economic crisis doesn't scare people into action. It exhausts them and normalizes decline. It turns temporary measures into permanent conditions. And by the time people realize what's happening, they've already adjusted their expectations downward. That is, historically, when systems lock in long-term outcomes. At this point, some people will say, this sounds pessimistic. But pessimism implies emotion. This is pattern recognition. And the pattern says this: when debt becomes structural, when policy tools lose effectiveness, and when growth depends more on confidence than productivity, the system doesn't collapse, it decays. Now, here's the crucial pivot. This doesn't mean disaster is guaranteed. It doesn't mean markets are about to crash tomorrow, and it certainly doesn't mean there is a single villain behind the scenes. What it means is that the rules of the game have changed, and most people are still playing by the old ones. If this is making sense so far, stay with me. Because the next section explains why this phase is historically the most misunderstood, and why it catches even smart people off guard. To understand why this moment feels strangely calm, we need to talk about expectations. After 2008, people learned to watch for crashes, they learned to watch stock indexes, they learned to watch banks, they learned to watch headlines, but the next phase doesn't announce itself that way. It shows up in second-order effects, it shows up in delayed consequences, and it shows up in places people aren't trained to watch. Consider this. What happens when interest rates stay higher for longer? Not suddenly, but gradually. Debt becomes heavier. Refinancing becomes harder. Risk gets repriced quietly, not all at once, but steadily. And over time, that pressure forces decisions. Companies delay hiring. Households delay spending. Governments delay reform. The system doesn't break. It stiffens. This is the moment when people start saying things like, why does everything feel harder than it used to? That question matters. Because historically, that feeling appears before measurable collapse. It is the human signal of systemic strain. Now, let's pause here, because everything we've discussed so far is just the setup. The real danger isn't what's already happened. It's what usually happens next in this phase of the cycle. And that's where the story becomes uncomfortable. The most important phase of an economic cycle is never the collapse, it's the adjustment. Because collapses are obvious, adjustments are not. And history shows that societies don't change when markets fall. They change when pressure becomes permanent. That's the phase we're entering now. To understand why this phase is so dangerous, we need to examine what happens when economic stress doesn't release itself all at once. In a sudden crash, fear spikes, then fades. In a slow crisis, stress accumulates. And accumulated stress doesn't just affect markets, it reshapes behavior. Historically, slow-moving economic pressure follows a consistent pattern. At first, people deny it, then they rationalize it, then they adapt to it. And adaptation is where the real damage happens. Because once people adapt to lower expectations, systems stop correcting themselves. This is why economists often miss these moments. The data looks fine. Growth is slow but positive. Employment exists, but quality declines. Markets fluctuate but don't collapse. Nothing looks broken. And yet, something fundamental is changing underneath. Let's talk about that change. In past eras, economic growth came primarily from productivity, better tools, better systems, better output per hour of work. But over the last 2 decades, growth has increasingly depended on financial expansion instead. More debt, more leverage, more asset appreciation. This works until it doesn't, because financial growth borrows from the future. And eventually, the future arrives. This is the phase where the economy becomes extremely sensitive to interest rates. Not because rates are high historically, but because the system was built assuming they would stay low forever. That assumption is now being tested, quietly, relentlessly. Here's the part that feels counterintuitive. Raising rates doesn't cause immediate collapse, it causes delayed consequences. Debt rolls over slowly, contracts reset over time. Refinancing happens in stages, which means the real impact appears years later. This is why the danger feels invisible. Now, look at history. In the late 1920s, the crash wasn't the true end of the boom. The real damage came afterward, when deflation, unemployment, and policy mistakes compounded the shock. In the 1970s, inflation didn't explode overnight. It crept in, then embedded itself, then reshaped everything from wages to politics. And in both cases, the early signals were dismissed as temporary. What we're seeing now fits this pattern disturbingly well. Not the events, but the structure. High debt, constrained policy options, and a public increasingly aware that something feels off. This is where the system becomes fragile in a new way. Not because it can't function, but because it requires constant intervention to appear stable. And constant intervention carries costs. Let's talk about those costs. When central banks stabilize markets for too long, they unintentionally change incentives. Risk-taking becomes normalized, debt becomes acceptable. Short-term stability becomes more important than long-term resilience. Over time, the system forgets how to absorb shocks naturally. It becomes dependent, and dependent systems don't fail cleanly. They resist until they can't. Now here's the crucial distinction. This is not a story about bad actors or hidden agendas. It's a story about systems responding rationally to constraints. Policymakers are not trying to cause harm. Investors are not acting irrationally. Institutions are not conspiring. They're all responding to incentives, and incentives shape outcomes. This is why blaming individuals misses the point. The risk is structural, and structural risk doesn't announce itself with villains. It announces itself with fatigue. Watch for the signals. People working more but feeling less secure. Households delaying major life decisions. Young generations feeling permanently behind. Public trust slowly eroding. These are not cultural problems. They are economic symptoms. Here's another historical parallel most people overlook. In periods of slow economic stress, political polarization increases, not because people become irrational, but because resources feel scarce. When growth feels limited, cooperation declines. That's not ideology. That's human behavior. This is why slow crises are more destabilizing than sudden crashes. A crash unites people against a clear threat. A slow crisis divides them. Everyone experiences it differently. Some feel it immediately. Some feel it later. Some barely feel it at all until suddenly they do. And that unevenness fuels resentment. Now, let's address the question everyone eventually asks. If this is happening, why do markets still seem calm? Because markets don't price discomfort well. They price risk events, and slow erosion doesn't fit cleanly into models. Markets are excellent at reacting to surprises. They are terrible at pricing inevitability, especially when inevitability unfolds gradually. This is why volatility can remain low while stress rises. This is why asset prices can stay elevated even as fundamentals weaken. And this is why relying solely on market signals can be misleading. At this stage of the cycle, the most important signals are not financial, they're behavioral. Are people taking on more risk just to maintain the same standard of living? Are institutions relying on increasingly complex mechanisms to maintain stability? Are policymakers emphasizing confidence over reform? Those questions matter more than any chart. This next part explains why this time feels different, not in magnitude, but in texture. In 2008, the shock was external to daily life. Yes, people lost jobs and homes, but the crisis itself felt like an event. This time, the pressure is internal. It seeps into everyday decisions. It affects what people buy, where they live, how they plan. There is no single moment to point to, just a growing sense of constraint. This is historically when narratives start to break. Official explanations stop matching lived experience. People hear that the economy is strong, but don't feel strong. That gap matters, because when perception diverges from messaging, trust erodes. And trust is the real foundation of economic systems. Here's a subtle but critical point. The system does not need to collapse to fail people. It only needs to stop delivering progress, and stagnation feels worse than recession. Because recessions promise recovery, stagnation feels endless. This is why long periods of low growth with high inequality are so destabilizing. They don't shock societies, they wear them down. At this point, many viewers start asking, so what happens next? And the honest answer is this: there are multiple paths forward. None of them are painless, but not all of them are catastrophic. History shows that systems under this kind of pressure usually resolve in one of three ways. Gradual reform that restores balance. Slow, difficult, and politically costly. Prolonged stagnation that normalizes lower expectations. Or disruptive adjustment triggered by an external shock. Which path emerges depends on decisions that haven't been made yet. This is where timing becomes unpredictable, not because outcomes are random, but because feedback loops are complex. Small changes can matter. Delayed responses can compound. And external events can accelerate underlying trends. This is why absolute predictions are irresponsible, and why anyone claiming certainty should be treated with skepticism. What matters is direction, not dates. If you're still watching, this next part is critical, because it explains why individuals feel trapped during this phase, and why that feeling is rational. When systems become rigid, individuals lose flexibility first. Wages lag, costs rise, options narrow. People respond by optimizing locally, taking on more debt, more work, more risk, to preserve stability. Ironically, this behavior stabilizes the system in the short term, but increases fragility long term. This is how slow crises sustain themselves. They feed on adaptation. And adaptation delays resolution. Now, pause here, because this is the moment most narratives avoid. Not because it's dramatic, but because it's uncomfortable. The uncomfortable truth is this: modern economies have become very good at preventing collapse, but not very good at restoring balance. And imbalance is corrosive. This doesn't mean collapse is inevitable. It means pressure will continue until something changes: policy, behavior, or expectations. Usually all three. So where does that leave us? Not with panic, not with certainty, but with awareness. Understanding this pattern doesn't give you control over the system, but it does change how you interpret signals. It helps you distinguish noise from structure, and it explains why this moment feels so strange. The crash, if it comes, won't look like 2008. There may be no singular event, no dramatic breaking point, just a recognition over time that the old assumptions no longer apply. That realization is the true turning point, because once expectations reset, systems either adapt or calcify. History is still being written and outcomes are still open, but patterns are forming. And ignoring patterns has never ended well. This is not a warning, it's an explanation of why this phase feels heavier, why solutions feel constrained, and why patience is wearing thin. The question isn't whether change is coming, it's what form it takes. Gradual adjustment, prolonged stagnation, or sudden acceleration. And that answer will depend on choices made quietly, long before headlines change. If you want deeper analysis of economic systems, not headlines, not opinions, not panic, subscribe. Because understanding patterns is the only real advantage history offers. And now, the tension remains unresolved, as it always does, right before systems change.